Welcome back to New Money. This evening we're discussing retirement and financial planning. My guest is Hetty Jaber, and if you'd like to email me, my email will appear on the screen. So now let's talk about marriage regime. Plays a big role. Let's talk about explain firstly pension interest, because is pension interest different to your fund value?
Yes, it is. Yes, it most definitely is.
Because those words are quite important, and just explain where they fit in.
Yeah. So pension interest is not the interest that you get on your pension benefit. We must just make that very, very clear. It is a term that is defined in the Divorce Act. So there are different definitions depending on what type of fund you are in. If you are in a pension or provident fund, the definition in the Divorce Act is the benefit that you would have received if you resigned on the date of divorce. So it's your resignation benefit. For a retirement annuity fund, it was the total contributions that the member made plus the total amount of the annual simple interest on it at a prescribed rate, and that prescribed rate is repo plus 3.5%. So every time that the repo rate changes, the calculation or the interest rate changes, which means that if you've been married for 30 years, to do that calculation, you would have had to keep track of all the changes. So it's a very difficult calculation to do. For preservation funds, there wasn't a definition in the Divorce Act. The definition was in the Pension Funds Act, and that's simply whatever is in your fund at that time. So what happened now is from the 1st of September 2024, they changed the Pension Funds Act. And the Pension Funds Act has its own definition for pension interest, and it's a very simple definition. It just says whatever's in your fund on that date. So you'd think, okay, fine, that's fantastic. Let's just go with that. It's so much simpler. But unfortunately, it's not that simple, because it depends on the wording in the divorce order when it gets to the fund. If the attorneys put in there pension interest as defined in the Divorce Act. Now remember, two-pot came in on the 1st of September. So with two-pot now, if you resign, all you can get is your vested component and your savings component. So if the divorce order said pension interest as defined in the Divorce Act, and you were a member of a pension and a provident fund, you're going to lose out, because pension interest is now limited to savings component and vested component.
So it's not has any bearing on the 2/3 of future contributions from the 1st September.
Absolutely. So you lose out. If it said pension interest as defined in the Pension Funds Act, it's a much bigger amount, because now it includes your retirement interest, or your retirement component. So you must be very, very careful which definition you use. If you look at the retirement annuity, so if it says pension interest as defined in the Divorce Act, it means that the fund has to do two calculations, because the Divorce Act tells you how much you can deduct, but the Pension Funds Act is going to say what the fund may deduct. So now you do the calculation under the Divorce Act. Now let's, for argument's sake, say that amount is 100,000. But if you do the same calculation in the Pension Funds Act, it's 90,000. Now the fund cannot deduct more than the Pension Fund Act allows, so it can only then take 90,000 into account, not the 100,000. But the divorce order said pension interest is defined in the Divorce Act. Now there's a shortfall. Now what do you think happens with that shortfall? The member will have to pay that out of his pocket, because that is what they agreed to.
So very important if you are, but let's understand, what is the entitlement of two spouses, both contribute to pension funds. One of the spouse has a much larger fund. What is the meaning in terms of if you're married in community of property, if you're married out of community of property, and then you talk about, and if you're getting divorced, what part of that becomes part of your assets for distribution?
I'm always surprised that people think that when you get divorced and you're married in community of property, that all your assets have to be divided in two. So if you've got a lounge suite, you're not going to take a hacksaw and saw your couch in two. So
one of the parties may be so hateful that they will.
But all the Divorce Act says is when you get divorced, if you were married in community of property or out of community with accrual, it says your pension interest is part of the assets in your estate. So it's just one of all the other assets. So you don't have to cut that in two. you must just take the value of that, look at other assets, and if I can give people advice, please do not touch your pension fund. You give something away, but you're losing the growth on that. And it's going to bite you when you get to retirement and you suddenly have, you don't have enough money because you gave it away. And the reason people do that is, I don't have to take anything out of my back pocket and hand it over to the non-member spouse. I give something away on paper. But just go do the calculation. And I think if members do that, they will realize the shocking effect of taking it out. So to your point, so if both spouses have pension interest, why do you want to give half of each away? Why don't you just do a calculation, and then the one with the bigger pension interest, that's where you make the deduction. But do a set-off on the balance. It just doesn't make sense to me why people do that. And I don't want to blame attorneys, but I don't think that attorneys necessarily understand what the impact is of doing that.
Because the attorney's advice is all about the legal response, the divorce, what's going to happen, and there's other things. So what we're really saying to attorneys are, maybe you need to make sure that the divorce agreement deals with it correctly. So let me ask you a question on preservation, because you mentioned the word preservation. Let's go back to the vested portion prior to the 31st of August, 1st September 2024. You can still withdraw your whole fund.
Yes.
You now convert it to a preservation fund. And we've always believed that the benefit of a preservation fund, tax neutral, you've transferred it, and you have access to those funds.
Yes.
Does that change transferring that money to the preservation? Does that change what you can withdraw in future?
No, it doesn't.
So you can still withdraw the full amount?
Yeah. The impact of the two-pot system it's very confusing for people because they look at it as one holistic thing. You must actually break it down into two totally separate parts. So look at everything before the 1st of September. So that's your vested component. The same rules that applied before the 1st of September, they continue to apply afterwards. So if you resign, and you take that vested component and put it in a preservation fund, you still have your one pre-retirement withdrawal on that because it's the same rules as the ones before, the same. But let's say you didn't have a vested component and you are one of those members that were never in a fund or you only started the employment life after the 1st of September. Now you resign. You don't have anything to take. You can't take your benefit. You just can't. But because you're not in that fund anymore, the fund doesn't want to keep your benefit there. You can transfer that to a preservation fund if you are entitled to do so, but you won't have a pre-retirement withdrawal. So the pre-retirement withdrawal does not apply to your savings component and your retirement component. It doesn't. So for members that start in a fund now, if they put their benefit in a preservation fund, they're not going to have a pre-retirement withdrawal. No, they won't have it.
So for new monies after the 1st September, virtually preservation fund opportunities falling away?
It does. So for those members, they can only preserve it until retirement, but they can't touch it before.
So Hetty, there are two questions that I want to do before we come to the end of the program. I'd love to keep you for another half an hour. The first is unclaimed contributions.
Unclaimed benefits.
Unclaimed contributions. You've overextended. You've paid more than 27.5% and more than 350.
Okay, so
disallowed contributions.
Yeah.
That's the first question. The second question I want you to deal with: why is the Financial Conduct Authorities not being more severe on companies who do not pay over contributions? So you've got 4 minutes to deal with those two questions.
Okay, so the previously contributions that didn't previously qualify as a deduction, it does come into play when you leave the fund. So let's say you retire. The first thing you do is when you calculate your lump sum amount, the tax on it, you first take off the contributions that didn't previously qualify. So let's, for argument's sake, say your total benefit in your savings component is 100,000 and you over-contributed to the tune of 20,000. That 20,000 is then going to come off your 100,000, but remember, it's only the previously disallowed contributions from the previous tax year. Because you can only determine what you can deduct as a contribution at the end of the tax year when you take your total taxable income into account. So it comes off the 100,000 then, and you will only be taxed on the 80,000 that remains. If in that same year you also over-contributed, it will only come off in the next year, and that will come off against your annuity income. The non-paying employers,
Yeah.
you know that the FECA now has a name and shame policy, where they publish all the names of the non-contributing employers on the website, and there are hundreds and thousands of them.
Yes, and I just don't understand. Why don't they take action? If you don't pay VAT on time, if you don't pay the tax pay that you deducted, the PAYE, there are enormous penalties.
The biggest penalty is that the directors of a company that's supposed to pay over contributions, they don't do that, they can go to jail. They can go to jail.
But no one's doing anything.
I think the problem is that somebody needs to lay a complaint at the police. So as an employee, if my employer doesn't pay over my contributions, they are stealing from me because they are deducting the contributions and they're keeping it to themselves. But employees are not brave enough to take on their employers, otherwise they're going to lose their jobs. So they have to choose between losing my job or losing my pension one day. So that fight I can fight later, but I cannot afford to lose my job right now. That's why they don't do that.
But I don't understand why the authorities who govern this, the police it, aren't more active.
But what can they do?
To the employer.
What
Threaten
can
the directors, we're going to prosecute you.
They don't have the money to do that. Do you remember the authorities only have the fees that the industry pay? So now you want the rest of the industry to pay for the employees that don't contribute. That's also not fair.
Okay. As mentioned at the beginning of the program, there's a strong push for people to retire early. If you choose to do so, there are three important factors to keep in mind. One, you will have contributed for a shorter period. Two, you'll miss out on the significant compounding growth that typically occurs in the final 5 to 10 years before retirement. And as Hetty says, three, your funds will need to last much longer, and you must be mindful of the risks of longevity as well as retirement inflation, which is considerably higher than current CPI. Hetty, thank you for joining me. We never got through to the emails. Next time you're back in town, we can do it. But I wish you all the very best, and enjoy Andre Roux in December. What a wonderful concert you're going to. I'd like to thank everyone for watching tonight. It's important to note that our program is to provide information and should not be construed as advice. Next week's program will be on business acquisition in South Africa's cash flow transformation and the capital gap. And you need to get hold of me. My details will appear on the screen. I'd like to thank you for watching, and good night.